Good morning everyone. I am Amlendu Maiti. Today I am gonna speak about suitable borrower profile for MFI individual lending, which is important topic in rural and microfinance. Microfinance institutions or MFIs play an important role in financial inclusion. They provide loans to low-income people who do not easily get loans from other banks. One important lending model used by MFIs individual lending, especially in urban and semi-urban area. In individual lending, the loan is provided to one borrower and that borrower is fully responsible for repayment because there is no group like self-help group or LGP. Selecting the right borrowers become very important. Now let's understand what individual lending means. Individual lending is a system where a loan is given to a single borrower, not to a group like self-help group or JPG. In this case, the full liability of repayment lies with one person only. The loan amount is usually larger than group loans because the borrower is often an established income earner. Since there is no group support, MFIs prefer borrowers who have stable income, credit discipline, and basic financial knowledge. Now understand why a suitable borrower profile matters. Having a suitable borrower profile is very important for both MFIs and borrowers. First, it helps ensure timely repayment, which reduce defaults. Second, it helps MFIs control credit risk and NPAs, which is important for financial sustainability. Third, proper profiling reduces operational cost because less follow-up and recovery effort is required. From the borrower side, correct assessment prevents over indebtedness and financial straits. Overall, a good borrower profile help, helps build long-term trust and relationship between MFIs and clients. Now, now I will talk about the borrowers who are best suited for MFI individual lending. First are established micro and entrepreneurs such as shop owners, tailors, repair workers and food stall owners. These borrowers have predictable cash flows which makes repayment easier. Second are urban vendors like street vendors and small service providers. Their daily or weekly income cycles match well with MFI repayment schedule. Third are graduated SHG or GLG members. These borrowers already have experience with group loans and have proven repayment discipline. Another suitable category is repeat borrowers with good repayment history. Since their credit behavior is already known, the risk of default is lower and loan appraisal becomes easier. Apart from borrower type, MFIs also look at some additional characteristics. The borrower should have a stable income, preferably for the last 6 to 12 months. Basic financial literacy is important, such as maintaining simple records and budgeting. A low dependency ratio is preferred, meaning fewer people depend on one income. Residence stability is also important because borrowers who migrate frequently are difficult to monitor. All these factors together indicate the borrower's repayment capacity and seriousness. Now I will talk about who is not suitable. Some borrowers are generally not suitable for individual lending. First are first time borrowers because they have no credit history and higher uncertainty. Second are borrowers with unstable or seasonable incomes where cash flow is irregular. Migratory workers are also risky because monitoring and follow-up become difficult. Lastly, over borrowers or those taking loans for consumption purpose are not suitable at, as this increase default risk. MFI MFIs should avoid such profiles to protect both institution and the borrower. Now I will tell some key assessment factors. Before giving an individual loan, MFIs assess several key factors such as income stability, repayment history, credit history, household expenses, and business viability. Most MFIs use a checklist-based appraisal combining financial, social, and purpose-based checks. Field verification is also very important. In conclusion, I want to say that individual lending works best when MFIs carefully choose experienced and stable borrowers. Proper borrower profiling helps prevent over-lending, reduce risk, and ensure sustainable microfinance growth. A balanced approach protects client while supporting MFI profitability. Thank you so much for watching this video.